This is Cathal Kiely submitting task 2.3 for course MBC 301, Blockchain 101 for Professor Brian Reedy. The topic is blockchain, tokenizing commercial accommodation real estate, and the task is to prove that it needs blockchain. Introduction. The world is becoming increasingly polarized between the haves and have-nots, where the idea of buying one's home is simply unattainable for most. Shelter is considered a basic human need, and the health of residential real estate is arguably the cornerstone of any economy. At the base of Maslow's hierarchy of human needs, we find a physiological level, which encompasses the basic, yet self-preserving needs, such as sleep, water, and shelter. Owning a property provides the comfort of security, tax benefits, a hedge against inflation, and the opportunity to leverage. Governments the world over are facing a housing crisis, where demand far exceeds supply, resulting in upward price pressure, whilst creating unmanageable barriers to entry. The result is a universal growth in the rental property market, particularly in large cities due to rapid urbanization. This project will demonstrate the ability for blockchain-powered technology to facilitate an easier entry to the property market, whilst attracting new levels of liquidity to the space. The proposal is anchored in the inherent immutability, transparency, and decentralized nature of the blockchain, and will focus on the specific build-to-rent developments to highlight the potential for disruption in this space. Background and challenges. The concept of buying a home is essentially impossible for most of those who live and work in cities. As it stands, accredited investors, or individuals who make less than $200,000 annually and have a net worth of less than $1 million, cannot invest in the real estate that defines our cities, as per Cooper in 2022. Traditional routes to acquiring real estate demand large amounts of liquidity and time, relationships with lenders whose requirements are hard to meet, and excessive third-party costs. The global housing crisis means that the majority of millennials are unable to buy a home. As per Flipovich in 2022, close to half of boomers were homeowners by the age of 34. Today, 75% are. By contrast, only 37% of millennials owned a home by the age of 34. Real estate is controlled by baby boomers, hedge funds, and those with large amounts of wealth. All outside of this tight circle are forced to rent. Corrigan said in 2022, London will become a city of renters by 2025, where only 40% of Londoners will own a home, as new research claims. Furthermore, the rents are so high that people are unable to save, as per Milner in 2022. Tenants of privately let homes in London are typically having to spend almost 40% of their income on rent, making it unaffordable to all but the highest of earners. Living and working in London, for example, with average savings will take at least 34 years to save up for the mere deposit on a home, meaning that the only choice for most is to become a permanent renter. But what happens when these people stop earning income? Who pays for their rent? This is a common problem across the globe and will create immense challenges for future governments. Blockchain, the solution. The value of the global real estate market is substantially higher and gives higher returns than both the global debt and stock markets combined. As you can see, the global real estate market is $286 trillion, where the debt market is $252 trillion, and the stock market is $89 trillion. However, the real estate market is substantially higher to invest in, leading to dominance by hedge funds and high net worth investors, where only 3% of the global population is invested in real estate, but over 80% view real estate as a good investment, as per Morton in 2021. Blockchain can revolutionize this market by introducing new levels of efficiency, cost savings, transparency, and trust. Tokenizing real estate involves the fractionalization of property into tokens, and storing said tokens on a blockchain where investors can secure direct ownership. They effectively own a tangible asset without buying or managing the property themselves. These tokens can be traded with ease, allowing investors the freedom they have trading any stock in any stock market. Consider a purpose-built rental development that has been fractionalized where one can buy pieces of the building in a digital token format at a price that they can afford. One might not own the full property, but one would have a share of it with all the legal rights afforded to any real estate owner, thus delivering the security of owning a property, realizing the capital gains of such, and reaping their share of any profits from the management of the business. The result would present the individual living in London with an opportunity to buy however much of the building they can afford, accessing all the benefits of owning real estate in the traditional sense at a fraction of the cost. The problem statement and the solution. The problem is universally clear. We have a housing crisis where it is nearly impossible for the average human to own and provide shelter for those they support. caused by a combination of lack of supply, increasing populations, urbanization, rising interest and inflation rates, logistical issues driving the cost of materials, COVID-19 restricting production, diminishing supplies of raw materials, but most importantly, the distribution of wealth. Average investors struggle to meet the current financial and legal requirements set forth by those in power to purchase property. The result is a small number of investors controlling the supply and forcing more and more people to accept the stress of being a permanent renter. I believe the distributed ledger technology of blockchain can disrupt, revolutionize, and democratize this space, affording everyone the ability to purchase real estate. This technology can provide all with the benefits and security of owning real estate, whilst de-stressing the housing crisis facing current and future governments. The paper demonstrates the power of DLT and the positive implications it has on the real estate sector. Looking at this table, it's clear to see how the traditional forms of buying real estate versus blockchain and how blockchain supersedes. Reduction in deposits, for example, from highs of 50% to nominal affordable sums. Assuming 100% of the risk on a traditional property you own in full versus manageable risk on a tokenized property. The cash lockup is years in traditional sense versus seconds should you wish on blockchain. Exiting traditional real estate investments is long and cumbersome, involving multiple expensive third parties. However, tokens can be traded cheaply and fluidly with no third-party involvement. Traditional sales require trust in valuers, lawyers, and brokers. Token trades are trustless. Managing tenants falls on the owner, 100% on the owner of traditional real estate, whereas fractionalized assets falls 100% on the management company. Finally, all eggs are in one basket owning a single apartment, whereas tokenization would allow smaller amounts of money to be diversified across multiple buildings, developers, and management companies to mitigate the risk. Furthermore, this DLT solution provides clear benefits to the developers, such as additional capital, where they can access new pools of liquidity, including the 2.2 billion unbanked in the world today, along with the 90% of the population who are unable to invest in property but viewed as a good investment. As Ree said in 2022, even if just 0.5% of the total global property market were to be tokenized in the next 5 years, it would be on track to become a $1.4 trillion market. Developers get direct access to cash, eliminating the need for expensive and intrusive banks and lenders. There's cost savings seen in the removal of ongoing expensive and inefficient costs built around lawyers, agents, surveyors, for example, and the efficiencies where you only need to pay for each agreement once, which is then immutably written onto the code of the smart contract and can be used in perpetuity. The transparency of blockchain allows for this storage of the likes of sales and purchase agreements, deeds, management contracts, agency agreements, fees, and commissions, for example. The irrefutable nature of blockchain allows time-stamped records in the smart contract, which will mitigate future legal disputes. And finally, smart contract triggers, which affords the developers the opportunity to write favorable triggers, which can be executed at the touch of a button with no need to negotiate, agree, and sign off with each and every individual that's involved in your business. These can be found in the likes of buyback options, on the hold investment as per pre-agreed mechanisms, and leveraging options. Technical specs. Stage 1, defining the structure. Developers decide on the type of asset they intend to digitalize, forming the likes of an SPV, a subsidiary, or a real estate fund. Shareholders' rights would then be determined as equity partners, loan note holders with a lien in the token, and rights to dividends of the building management, for example. Further rights may be extended to the internal governance to ensure the management operates with integrity. Smart contracts would dictate the definition of the token, along with the rights and obligations of all parties in exactly the same way a shareholder or loan agreement would do today. Stage 2, choosing a platform. The creation of a permission quorum platform, for example, built on an Ethereum blockchain, making full use of smart contract technology. ERC-20 tokens would be issued, and the blockchain would employ an Istanbul BFT consensus protocol. Designated maker nodes would be afforded the right to create new blocks on the chain, which will be voted in by the community using Quorum Chain, an innovative method to achieve fair consensus across all nodes. A permission blockchain is necessary to deliver increased levels of comfort, security, and privacy. The governance would implement a strict KYC onboarding process and maintain full control of certain components to ensure the business is legally compliant. Quorum has the power to manage two databases, a private state and a public state. The private state would wrap the whole platform to protect users from malicious attacks, along with allowing the developer to enter private contracts with certain actors. This would be beneficial for tailored agreements with the likes of sales agents, commissions, or scaled investors, for example. The public state, however, would use distributed ledger technology to enable P2P trading under pseudonymous profiles to further improve security. A secondary exchange would be set up to facilitate this trading. And then finally, stage 3, tokenization. Assume a company is looking to develop a specific build-to-rent development of 100,000 square feet with a build cost of $30 million US. The company could theoretically mint 1 token per square foot at a value of $300 each and sell under an STO or security token offering. During the STO, the tokens are created and issued on the blockchain as regulated assets similar to stocks issued on the stock market. The sale and purchase of the tokens would transact utilizing smart contracts, which would operate under strict adherence to local law. These self-executing contracts would outline the ownership of the real estate for the token holder, along with the obligations and any triggers between the developer and purchaser. This structure would remove the high barriers of entry and empower anyone entering the real estate market at a manageable price point. Furthermore, this fluid trading of tokens would cost the developer neither time nor money and have zero impact on the management of the building. Challenges in summary. Innovative disruptive technologies will always face challenges in the path to acceptance and adoption, and blockchain-powered solutions certainly have some obstacles ahead. Regulation. Governments need to regulate this space to encourage mass adoption. Education. The public needs to be made aware of this technology and understand the benefits it carries. There is unfortunately still a belief that blockchain and cryptocurrency are one and the same, carrying the negative stigma and volatility it has become famous for. Powerful competition. The large banks and lenders control the commercial ecosystem and have close ties to governments and regulators. This solution is not in their interest, and one could expect strong resistance from this sector. Scalability is currently a concern with blockchain, but I believe all these problems can and will be solved in the space as it evolves. If you look at the decision tree, the blockchain decision path, this use case clearly demonstrates the suitability of the build-to-rent sector to adopt DLT. There's multiple parties who do not know one another, trading valuable assets in a P2P format in a private setting, suggesting a permissioned blockchain is the option, or the best way to go. So in conclusion, blockchain is simply a distributed ledger technology at its core, which offers the ability to trade and store immutable data on a trustless network. There are many powerful use cases for this, and the tokenization of real estate is certainly one. This paper has demonstrated the fundamental process in which employing blockchain to tokenize fractionalized real estate can contribute to solving the housing crisis. It has the power to disrupt the real estate market, pulling down unnecessary barriers to entry and democratizing the space. This technology is proven, and this use case demonstrates that developers and the purchaser will benefit from the implementation of such. Blockchain will be more efficient in managing the process of buying real estate. It'll be faster, cheaper, and better. Thank you.